Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Happy Friday. Welcome to another episode of Friday Follow-Up here on the Cash Flow Chronicles. I'm your host, Jonny Cattani, and we have made it through another week. If you have been an avid listener, we got a little surprise yesterday. By we, I mean you, the listener, from me. It was my first non-Friday follow-up solo episode, and you can go ahead and give it a listen, but there's more to come. I kind of explained the future of the podcast, which I'm very excited about. So feel free to give yesterday's episode a listen. Hope you guys had a great week. We're getting just absolutely crushed with more rain and snow here in Utah. And I know a lot of people relate to me because it's now come up multiple times in conversation, but this has been a very long winter and it's been very, very challenging. Because usually I can ski a lot and naturally it's been an incredible year of skiing and I haven't been able to get out much. I've been focusing on work, maybe too hard, maybe I should have gotten out and skied a little more, but the good news is the season's not over. In fact, next weekend, I am headed to Steamboat to go ski out there with some friends. So lots of skiing. And in fact, I'm probably going to get up and try to do a little bit more, but it's been a tough winter, I'll be honest. And I know a lot of people are feeling it. Just felt like it's dragged on. We've had a lot of bad weather. And, I can't speak for other places, but I know here we haven't gotten nearly as much sunshine as we usually get in the wintertime, which has really been the biggest challenge for me. Like all humans, right? I thrive with sunshine. I know some people more than others. Personally, this winter, and I think I've mentioned before, has kind of opened my eyes and made me realize that I actually value sunshine and warmer climates maybe a little bit more than I realized. So some changes will most likely be coming for next winter, but I digress. Still been a great year so far. A lot coming up. Been working hard on a lot of things, which I'm really excited about. Like I teased yesterday, hint, hint, if you want to go listen, we've got some potential opportunities outside of real estate. So go listen to yesterday's episode. You get a little bit more information. But today, so I mentioned yesterday what the plan was for my podcast. So Fridays are going to be more about like kind of what's happening in life as opposed to business. But we really need to talk about, so I'm recording this as I always do on Wednesday, right? So today the Fed announced a 25 basis point increase, which I said was coming. If you pay attention, so I was on a networking, virtual networking meetup group on Monday, and they had this capital raiser on who's raised tens of millions of dollars. He's now he coaches capital raisers, and it's not Hunter Thompson. It's not Hunter Thompson, and he was talking about how let me find who it was, because he was a super awesome guy. And he was talking about how if you want to be a good capital raiser, then you need to know what's happening in the marketplace. And I'll say this, it really doesn't just go for capital raisers. If you want to be a good investor, it's so important to know what's happening economically. And that doesn't just go for US economics, although, that's, if you're only going to choose one, obviously choose, US economics. But to be 100% honest with you, it's really, really important to know what's going on in the world. And in order to know what's going on in the world, you need to read the news. So I know I've talked about how you shouldn't read mainstream news, and that is pretty true, right? Like by mainstream, I'm talking like let's put it this way. And I don't want to get outside of talking about like business and economics here, because I try not to get super political, although it does happen, right? It's all intertwined. But basically what I'm getting at is you shouldn't be getting your financial news from Fox News, from CNN, even CNBC. You got to be careful. So the one that was recommended, and it works out perfect, and made me feel really good because I've already been doing this. But I read Wall Street Journal every morning. I drink my coffee and I read the Wall Street Journal. And the reason that it's important capital raising is because when you're talking to investors, it's important to know what's going on economically, right? So you can tailor that to your conversation to help them kind of plan around what's happening, to help them plan around what's happening in the country, and what to do with their money and how to prepare and different things like that. Now, I'm not a financial advisor, right? So I never advise, simply just, help people understand. Okay. So the man was, and I've heard him speak before. He's actually spoken on Raised Masters before. Edmund Chin, great guy, super knowledgeable, super down to earth too, very, very approachable. But basically what he was saying is that, you should be reading the Wall Street Journal for an hour every day, so you know what's going on. And I already do that, which is perfect. At least 30 minutes every morning, like I said, with my coffee. And it's super important to know because it will help you make informed decisions. And I've talked about this before, that think about a decision you've made, and don't get me wrong, I'm all about spontaneity and off the cuff. But when it comes to investing, the more information, this is a tough thing to say. I don't want to blanket statement this. I don't want to say something like the more information you have, the better decision you're going to be, because there is such a thing as analysis paralysis, where you can get too much information. But it's important to know who you're investing with and why, right? Those are very important. And certainly there are investors. I have some investors in my group who just follow my lead, and that's totally fine too. It's totally up to you how you want to make your investment decisions. But having correct information is important, right? So you can at least have an idea of what's happening. And I will say this about the investors who just follow my lead. They are informed. They're intelligent humans. They understand what's happening economically. So they know why they're doing it. And, one of them is a very, very good friend. And so, it's more like just, it's a know, like, and trust thing, right? He just trusts that I'm not going to lead him astray. It also helps that I'm investing in everything alongside my investors. That is super, super important, especially in the beginning. That's how you're really going to get the trust. And that's really why I was able to raise the 200,000 last year, because I was investing as well, and I still stand by it, and it's been a great investment. But what I'm getting at is to come full circle, is the Fed raised interest rates 25 basis points. And if you've been reading financial news, that's not a shock to you. In fact, they were even potentially thinking about going another 50 basis points, or 0.5, whatever you want to call it. I'll teach you guys a little lingo. If you want to sound like you're really into finance, and you're a finance guy or girl, is say bips. Say, oh yeah, the Fed raised the Fed rate increased by 25 bips, because basis points is shortened into how you would put it, is you would put 25 BPS, right? So BPS, which, is like bips basically, right? So there's a little lingo for you in the biz. So They raised another 25 basis points, 25 bips. We knew that was coming. There was talk of them not raising it at all, but they've made it very clear that their ultimate goal is to get a grip on inflation, and that's what they've been able to do is they've been able to show us that it is possible to tighten monetary policy and still protect the system, right? The banking collapses were not, they are because the Fed raised interest rates super fast, but they're really, when you boil it down, it's mismanagement of risk. And these banks invested too much at too low of an interest rate, and they were not able to get out of it. Silicon Valley Bank had a $20 billion bond portfolio, which included mortgage-backed securities, which you guys might recognize those from 2008, and then also treasuries. And the average rate of return was like 1.79, 1.8%. And then when you can go out onto the market and get, 4% right now, or I think the 10-year treasury is at like 3.8, you're going to get crushed, right? There's no value. You're not going to find anybody who really wants these 1.8% interest rate bonds. The only perk is, having them through maturity, getting the principal back plus the interest. Now on $20 billion, 1.8 is not bad, right? Especially when you're trying to be safe, which is ultimately what they were going for. But basically, the Fed has made it clear that they're trying to get a hold on inflation. Now, what they did say in today's meeting is that this could potentially be the last one of the year. Could potentially. They're going to keep an eye on it now. Ultimately, I think they'll go one more 25 basis point rate hike, and that will come in a couple months, and then they'll leave it. And that's been their plan all along, is this hike, one more hike, and then just leave it. And that'll put it right at about 5 to 5.25% in terms of the overnight rate. And, it hasn't been that high since 2007. And, with the banking collapse, the increase in interest rates, there's going to be some tightening of spending. People are going to be afraid now. And that's what they're going for. They really want to slow spending. And then eventually what their plan is to, maybe by December. So basically like end of Q4, beginning of Q1 next year, which I've been saying all along, start to slowly bring it down, right? Which will kind of, again, signal, an expansion, an economic expansion, right? So this is they're contracting an economic contraction right now. And then ultimately, by next year, begin to slowly expand the economy. Now, whether or not that works, we'll see, right? We've seen some banking collapses. UBS, if you guys haven't heard, UBS had to buy Credit Suisse. It was basically a forced merger by the Swiss government, which now makes UBS like a banking conglomerate, especially in Switzerland, which is basically like 80% of their economy is banking, right? Like they're the banking capital of the world. Just go to Geneva. You can see it. And so what's happening and how this all relates to real estate, especially commercial real estate, excuse me, I'll take a sip of water, is when interest rates are unpredictable, it makes it where the market becomes unpredictable, right? So sellers aren't really ready to bring their prices down because interest rates haven't settled. Once interest rates settle and we have a clear understanding of what's going to happen, then what'll happen is when the market is prepared for interest rates to stay high, Like let's say, the Fed is like, okay, this is where interest rates are going to stay. And everyone's like, all right, well, interest rates, these high interest rates are here to stay. What you're going to start seeing is you're going to start seeing sellers who are like, okay, I'm going to have to bring my price down because it's going to have to match interest rates. Like people can't hold on to their assets for forever without refinancing or selling some kind of disposition because your longest fixed rate term is 10 years for commercial real estate. So, if you're coming up against a 10-year loan now, your only two options are going to be to refinance to a higher interest rate or sell it, right? And if you're selling, you're going to have to sell into a high interest rate market, which means you're going to have to be willing to bring your price down. So there's a lot of variables at play that are kind of, still up in the air, so to speak, and it's making it very challenging. Now, acquisitions are still happening, deals are still happening, they're still out there, right? It makes it challenging to navigate, especially because, if you've ever bought a house, that your interest rate isn't necessarily always locked in right at the beginning. A lot of times it can change throughout the closing process, especially now with, the increased variability that we're having. So it's made it a challenging market to navigate, which is why transaction volume is down. Now, naturally, this is a slower time of year anyway. So there's a lot going on, a lot to keep an eye on. And it lends itself to being smart with your money, pay attention, right? And, there's going to be opportunities that present themselves. And so it's going to be very, very important. In fact, I know what I'm going to talk about next week is I really want to talk about understanding risk and how to understand your risk profile and, why mindset around risk is so important because risk is a perception thing, right? Like some people, when I was a stockbroker, there were people who loved the penny stocks, what we call pink sheet, which are not listed on your typical like NASDAQ and New York Stock Exchange. Their companies don't have to release their filings every quarter like like how Apple and Tesla, have their quarterly earnings calls. These pink sheet stocks don't have to do that. And what I'm getting at is that some people love that stuff because they traded for less than $1. It wasn't crazy for them to trade for, a tenth of a cent, so less than a penny, right? And so, you can go buy 100,000 shares for, $1,000, right? Or whatever it was, right? And so what happens is if all of a sudden that goes to 1 cent, well, I mean, you just, basically doubled your money, right? And so people like that and were willing to take that risk. And others thought it was crazy, right? They only wanted to trade blue chip stocks. It's just like your Apple and your Nike and, your kind of more predictable stocks in terms of, what they're going to do, how their earnings are going to go. You can, chart them and get an idea of what's going to happen more or less, right? Obviously, we all know the stock market can change on a dime. So you can never truly predict or understand. Well, you can understand, but you can't truly predict. And so, a lot of people, and so that translates, right? For me, I have a low risk tolerance. I am willing to take a risk for a higher return because I'm young and because to me, money is a replenishable resource and you can always go make more of it. I understand not everybody agrees with that. I totally get it. So next week, I'll kind of explain my mindset, my understanding there. There's some things, some things at play there. But ultimately, it's important to understand your risk. And so what I'm getting at is that with this ever-changing environment, it's important to learn your risk profile and then find things that fit that risk profile. And they are available and those opportunities will present themselves. But you need to start paying attention now so you know when something is an opportunity. That's ultimately what I was getting at. So that's the show for today. Really just wanted to discuss the Fed rate hike and, what it means and how it relates economically. Still a lot to keep an eye on, still a lot unknown, right? We still haven't seen the full fallout from these banking failures. As I mentioned before, Silicon Valley Bank had a $20 billion bond portfolio. A lot of that was mortgage-backed securities. And once they unwind those, meaning they sell them out into the market, that's a lot of bonds going out into the market, which when there's a large sell order, so a lot of stuff is being sold, that drives the price down, right? Because there's more supply than there is demand, basic economics. So something to keep an eye on as we move forward. I'll certainly keep you guys updated. As always, I appreciate you listening. Very, very grateful for you guys. Downloads are starting to increase, which I love to see. And I will... please follow me on social media at Jonny Cattani, Jonny with no H, JONNY CATTANI. You can find me on all your favorite platforms. I will talk to you guys next week. Peace. Oh, actually, one last thing. Finally got everything working. Go to investwithcattani.com and my video series is almost done and will be released soon. And that list will get it first. So investwithcattani.com. Sign up for my mailing list and for the 5 steps to passive investing. Very, very excited. I will talk to you guys next week. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CattaniCapitalGroup.com to learn more.